This is the Retirement Lifestyle Advocates radio program. I'm your host, Dennis Tubbergen. Glad you decided to tune in today. Hey, joining me in segments 2 and 3 of today's program is my special guest, Mr. Peter Schiff. Many of you who are longtime listeners to the program will recognize Peter as a returning guest. Peter is a frequent commentator in writing, on radio, and on television about the investing and economic markets. And I'm going to talk to Peter about his take as to whether or not the U.S. economy is in recession. What does he expect will happen with stocks, gold, and U.S. treasuries in the future? And again, that will all be in segments 2 and 3 of today's program. I do have a free report available. It is titled Tax-Free Retirement Income Strategies. If you'd like to get your copy of that report, just visit requestyourreport.com. And when you do request the report, I'll also send you a copy of my best-selling book, Revenue Sourcing, which contains a retirement planning strategy for the current economy. So again, the website to get the report and the book is requestyourreport.com. You know, there's an old weather saying that some of you may be familiar with. I guess it's more of an adage. And it says that a red sky in morning and sailor take warning, but a red sky at night is a sailor's delight. Some of you have probably heard that old adage, and more often than not, at least as an armchair meteorologist, this adage seems to hold true. Now, there's another reasonably accurate tool when it comes to predicting recessions and economic downturns. The most accurate tool, particularly in the U.S. economy, which is heavily dependent on consumer spending, is actually the level of consumer spending taking place. When consumers are spending money, it's a good sign for the U.S. economy. On the other hand, when consumer spending slows, it's bad news for the U.S. economy. Now, despite some of the data that's being reported that says consumer spending is up, you have to stop and take inflation into account. Is consumer spending up, or are people paying more for the items they're buying and actually buying less? And I would argue, when you look at the other stats, it's the latter. Inflation is taking its toll, and it's really taking its toll on lower income Americans. And now the Fed has announced that we can probably expect interest rate cuts or more easy money policies in the near future, probably by the end of this month, maybe the middle of this month. If that is the case, I expect that inflation will only get worse, further straining lower and middle income Americans. Now, Dollar General, many of you are familiar with, but if you're not, Dollar General is a retail store that caters to lower income and bargain-conscious consumers. And its stock recently had its worst day on record. I'm going to give you just a little bit from an article that was published on the Gateway Pundit. In fact, if you want to read the article, I have a link at Retirement Lifestyle Advocates, and that is in my September 2 newsletter just this past week. So a bit from the article, Dollar General suffered a record one-day drop as the company stock tanked amid a warning about the struggling U.S. consumer. The Thursday trading day marked a slaughter for Dollar General, seeing the stock crater by 32.01%. That's according to Barron's. It was the company's worst one-day decline in history, smashing the previous record drop of 19.5% set on June 1 of 2023. Dollar General has been publicly traded since 2009. Now, Dollar General is not a small player in this market. According to the Financial Times, Dollar General, which is based in Tennessee, has over 20,000 locations across 48 states. Now, Dollar General's core customers are typically from households that bring in less than $35,000 annually. Todd Vasos, who is the CEO of Dollar General, said that group of people is feeling more, quote, financially constrained, end quote, than ever. Vasos says, quote, the majority of them state they feel worse off financially than they were 6 months ago, as higher prices, softer employment levels, and increased borrowing costs have negatively affected or impacted low-income consumer sentiment. That's the end of the quote, and Vasos said that on an earnings call. Now, the higher prices that Vasos mentioned are due in large part on inflation. Now, inflation works as a double-edged sword against consumers. These consumers have to pay higher prices for what they need as the U.S. dollar loses purchasing power. And in rural towns and in poorer areas where Dollar General tends to place its stores are among those places most affected by economic downturns. Under this environment, the CFO of Dollar General said the store's typical customer has, quote, started to run out of money by the end of the month. Dollar General is also facing problems that many other retailers are facing, chiefly shoplifting and other forms of theft. Now, the retail industry calls shoplifting and theft shrink. You have customers taking five-finger discounts. You also have employees helping themselves to inventory. Businesses that opt for private security have increased labor costs from this. They also have some potential liability. And some stores have even suggested that they implement a one-on-one shopping experience where each customer is guided by an employee. Less than ideal if you're just browsing. So I expect that we're going to see more of this, and I believe that the Fed, by decreasing interest rates, rather moving ahead, will likely exacerbate the problem. If you'd like to learn about a strategy that could potentially protect you from what might lie ahead, I'd invite you to get this month's special report. It's titled Tax-Free Retirement Income Strategies. When you request the report, I'll also get you a copy of the Revenue Sourcing book. Again, go to requestyourreport.com, and I'll be glad to send you all that information. The website, again, requestyourreport.com. I'll be back after these words with my special guest, Mr. Peter Schiff. Welcome back to RLA Radio. I'm your host, Dennis Tubbergen. Joining me once again on today's program is Mr. Peter Schiff. Peter is a returning guest. He was on the program about a year ago. Peter is the founder of Euro-Pacific Asset Management. Europac.com is the website. You should also check out his commentary at schiffgold.com. And Peter, welcome back to the program.
Oh, my pleasure. Thanks for having me on again.
So, Peter, Jerome Powell, at the conclusion of the Jackson Hole meeting, said that the path forward as far as policy is concerned is clear. We now need to start cutting rates. What's changed?
Well, what's changed is that the government and the banking sector and the economy are struggling with the higher rate. And so the reason that the Fed is cutting rates is to try to relieve that burden. It's clear that the economy is under, substantial pressure. The labor market has weakened considerably as a result of the hikes. But the one thing that the Fed hasn't accomplished was getting rid of inflation. They're trying to pretend that inflation, even though it's not 2% yet, they claim that they're confident it's headed there, and so they can start cutting rates, even though inflation is still about 3% the way they measure it, which means it's probably 6% if you measured it properly. But I think inflation has already bottomed, even the way they measure it, and is headed much higher. And the Fed has not won the inflation war. It's actually surrendering because it wants to try to prop up the economy and try to make it so that the government and other debtors can continue to make payments, because the higher interest rates are becoming a huge burden, not only on the government, but on the sectors of the economy that are interest rate dependent. You know, we just got the home sales numbers the other day, and they're actually worse than at the depths of the COVID lockdown. So, you're seeing substantial weakness, and the Fed is, now trying to do what it can to prop everything up.
So, Peter, in the past, when the Fed has started cutting rates, I don't know what the track record is, but the vast majority of the time, the economy has followed by going into recession. The Fed is still putting forth the notion that it can engineer a soft landing. Is there any possible way they can engineer that?
No. I mean, I think we're already in a recession. I think that they will continue to revise the numbers the way they did with the jobs numbers, where they went back and they said 818,000 jobs that we said were created. It turns out they weren't created. Well, I think they're going to revise the numbers yet again, because I think they're still too high. And by the way, the only jobs that have really been created over the last several years are part-time jobs. And those jobs went to people who already had jobs and would prefer not to have these extra jobs, but they've been forced to moonlight because it's the only way to pay the rent or to, pay for the groceries. We actually have fewer full-time workers now than we did when Biden took office. So all of these jobs are just, a fantasy. And meanwhile, the jobs are, low-paying jobs, given that, they're part-time, they're service sector jobs. And a lot of the jobs, the majority, I think, are actually government jobs. Those are the only full-time jobs that have been created. Of course, a lot of full-time jobs have been lost to offset that. But those are non-productive jobs that are paid for by larger deficits and higher inflation. So, the economy is much weaker than everybody claims. And in fact, even if you look at the official unemployment numbers, you have to look at the U6 number, not the U3 number, which is the one that gets all the headlines. But the U6 number is the one that includes a lot more people who really are unemployed, and that rate is significantly higher. In fact, that was the only rate we used up until 1994, when the government, slipped this other one in to try to pretend that unemployment was lower than it was. But I look back at the 53 years between 1994 and 1941, and there wasn't a single year of those 53 years where unemployment was as high or higher than it is right now, the way the government measures it. So we already have high unemployment. It's just going to become a lot higher in the months ahead as the recession gets worse.
So, Peter, you had mentioned debt and the fact that the Fed potentially is dropping interest rates to allow maybe in particular the government to make their debt payments. I recently read that 3 out of 4 tax dollars collected from personal or individual income tax returns now goes to pay interest on the debt. Seems to me we're really close to a reset here, aren't we?
Oh yeah, I mean, interest on the debt is now the third biggest line item in the budget. It just surpassed defense this year, but by next year it's probably going to be bigger than Medicare or Social Security. And it's just going to keep on rising because the national debt is growing by about $3 trillion a year. And so we have to pay interest on that $3 trillion. Plus, we have to constantly refinance the $35 trillion of debt that's already out there. And that has to be refinanced at much higher rates than what a lot of the debt was originally taken out at. So, yeah, I mean, that's really why the Fed stopped hiking. It wasn't because inflation was 2% or was even on the way down there. In fact, if you remember, we got several banks that started to fail, Silicon Valley Bank, Signature Bank. It was the failure of banks that stopped the rate hikes. Because if the Fed would have continued hiking, a lot more banks would have failed. And in fact, the only reason that more banks didn't fail is because we had massive bailouts that were instituted at that time. But that was, like putting a Band-Aid on a cancer. The entire banking system in the United States is insolvent. And the Fed has to know that. And that's a reason why it's cutting rates. But it's not going to work because what's going to happen is these rate cuts are going to be a catalyst for a resurgence of inflation. Not that inflation ever went away, but it came down from 9% peak to around 3%. That's going to go back up. In fact, I think we're actually going to go higher than the prior peak of 9.1 on this next cycle. But of course, prices never came down. So even when inflation came down to 3%, that still added 3% to the already high prices. So even when they say, hey, inflation has come down, prices are still going up. And so there's no relief for the American consumer.
Well, I'm chatting today with Mr. Peter Schiff. He is the founder of Euro-Pacific Asset Management. The website is europac.com. I'd also encourage you to check out his blog at schiffgold.com. So, Peter, what ultimately is your inflation forecast? I mean, the Fed seems to have a choice here between trying to save the economy and save the currency, and it seems like they're leaning toward the economy. So how bad does this get for the U.S. dollar?
Well, it's going to get very bad. In fact, the U.S. dollar index hit a 13-month low earlier this week. It's bounced up a little bit since then. We actually hit a 13-year low against the Swiss franc, so that's kind of been the strongest of the currencies. But we're only about 7% above an all-time record low versus the Swiss franc. And if you recall, or maybe you don't know, but before we got the drop in the CPI from 9% to 3%, in the year prior to that, we got a 24% rise in the value of the dollar relative to foreign currencies. And that was in anticipation of all the rate hikes. And that's really what brought the headline inflation rate down, because the stronger dollar on global foreign exchange markets brought down oil prices, other commodity prices, which are big in the headline CPI. Well, the dollar index has already dropped 10% from that peak, and to me, it looks like it's getting ready to crash another 10 or 20% soon. So the dollar is going to lose more than it gained, and that's going to be the catalyst for much higher prices. And so we're going to end up with stagflation. So the Fed's not going to save the economy. The economy is doomed. And in fact, it was doomed based on the bad decisions, the mistakes that the Fed already made in the past. The Fed never should have lowered interest rates to zero. It never should have left them at zero for more than a decade. It never should have done all that quantitative easing. All of that was designed to postpone the pain of allowing the markets to correct for the mistakes of the past. But by doing that, we made a lot bigger mistakes. And so now there's a lot more pain that we're going to have to deal with than what we would have dealt with had they done the right thing over a decade ago. So inflation is here to stay. It's going to get much, much worse. In fact, you can look at inflation as a tax, because that's really what it is. Inflation is how the government is funding itself. The government is running massive deficits to pay for all these programs. The public doesn't get those programs for free just because their income tax didn't go up or their payroll tax didn't go up. They're paying for it through higher prices, because instead of the government taking your money, it takes your purchasing power by having the Fed print the money that it spends. And so that increases the amount of money in circulation, and that reduces the value of every unit of the currency that's already in circulation. So that means everybody's savings are worth less, everybody's paychecks are worth less, and that's why everything you buy costs more. And those higher prices are simply the tax you pay to fund all the deficit spending. And the deficits are going to get bigger, so the inflation tax is going to get higher.
Well, Peter, we've got 1 minute left in this segment. You mentioned that the banking sector, in your view, was insolvent. That's a pretty scary statement. How many more banking failures, or how is this going to be like 2007, 2008 all over again, in your view?
Well, it's much worse than that, because, in 2008, the only problem loans were the ones that were going into default, right? So that was a small percentage. but that was enough to cause that crisis. And that was only in residential. They didn't have any problems at all in commercial. Commercial loans were fine in 2007, 2008. It was just the residential mortgages, a lot of the subprime loans that collapsed the system. But today, the problem that the banks have is not with the mortgages that default. It's with every mortgage that they wrote, because they were selling mortgages to people with 3 and 4% payments, and everybody loved it. For the borrower, it was great for a long time. You can go out and buy a house and get a 3%, 4% mortgage. That was great for the borrower because he had a very low payment. Now, the banks were still making money because they were borrowing from the Fed at next to nothing when rates were zero. So even though they were only charging 3% or 4%, the banks still made a lot of money on those mortgages. But now it costs the bank 5.25% to get that money from the government that it's loaned out at 3 or 4. So all of these mortgages are underwater. They're worth less than the face value, and the banks actually are losing money on all these mortgages because it costs more to get the money from the government than they're getting from the borrower. And at the same time, the commercial loans are a complete disaster. Commercial real estate prices have collapsed all over the country. And a lot of these loans are going to come due in the coming years, and the borrowers are just not going to repay them. They're going to be sending the banks the deed to the property. Just like a lot of people defaulted and mailed in their keys on their home loans, you're going to see something similar in the commercial real estate market. I mean, it's been decimated by higher interest rates, but also by people working from home. And so a lot of companies don't need as much space as they used to have. A lot of retailers have downsized because more people are shopping at Amazon and other online venues. So there's not as much demand for retail stores or office space. And so that's brought down the income for the properties. At the same time, the owners of these properties have seen a big increase in their debt service costs. So prices have crashed. You have commercial real estate down 30, 40, 50, 60% coast to coast. This is a major disaster for the banks that didn't even exist in 2008. So the banking system is in far worse shape now than it was then. The thing is, will the government allow all these bankrupt banks, insolvent banks, to fail, or will they print up enough money to prop them up? And that's what I think they'll do. And so that just guarantees even more inflation.
Well, my guest today is Mr. Peter Schiff. He's the founder of Euro Pacific Asset Management. The website is europac.com. Check out his blog at schiffgold.com as well. I'll continue my conversation with Peter when RLA Radio returns. Stay with us. Welcome back to RLA Radio. I'm your host, Dennis Tubbergen. I'm chatting today with Mr. Peter Schiff. Peter, many of you recognize as the founder of Euro Pacific Asset Management. The website is europac.com, and I'm a regular reader of his blog at schiffgold.com. I'd encourage you to do the same. Peter, I find it interesting that central banks around the world who are really in charge of the issuance of fiat currency seem to be abandoning the very currencies they create in favor of accumulating gold. Is that a new trend, and what should we read into that?
Well, central banks have held gold for as long as we've had central banks. And, before we conned the world with Bretton Woods into holding U.S. dollars, that's all central banks had as reserves for their currency was real money, gold. But we got the world to move off the gold standard to a dollar standard, but that was because the U.S. had most of the gold, and the dollar was convertible on demand into gold. And, that changed in 1971 when Nixon, took us off the gold standard. But I think what's happened recently is the central banks can read the writing on the wall. They know that the dollar's days are numbered given the imminent sovereign debt crisis that's coming our way. And they're trying to reduce their dependence on dollars and replace dollars with a alternate reserve. But rather than, opting for another fiat currency, rather than trading the dollar for another, for the euro or the pound or the yen or something like that, they're just buying gold because gold is real money. It's not somebody else's liability. And more importantly, too, you don't have the political risk. The Biden administration really sent a warning to everybody that they better get out of their dollars or they could be the next Russia. Because the way we punished Russia because of the Ukraine situation was that we sanctioned them, we cut them off of SWIFT, we basically seized the treasuries that they held with the Fed, and basically we told everybody else, the Chinese, the Saudis, you could be next. If you do something that we don't like, we have power to, punish you by taking your dollars. And so what the world now wants to do is get rid of the dollars before the U.S. has the chance to do that. And so you sell your dollars, and then what do you buy with them? You buy gold. And that's what's going on. And that's the main reason that the price of gold is above $2,500. We hit a new all-time record high this week, backed off a little bit, but not much. But prices are headed much, much higher once individual investors start to compete with these central banks, and when central banks get more aggressive in their accumulation, which they will, and of course, eventually the institutions, the pension funds, the endowments, the hedge funds, everybody is going to try to get in on gold when they realize just how much value dollars and even other fiat currencies are going to lose. So this is just the early stages of what's going to be a real gold rush around the world. And so that's why I've been encouraging people, don't think that we're high now just because we're at 2,500. Gold is still extremely cheap at 2,500 compared to where it's going. Silver is probably even cheaper, just under $30 an ounce. So both these metals are low. People should go to Schiff Gold and buy them as quickly as they can before they have to pay a lot more money to get it. And I think the best investment right now, if you're a speculator and you can afford the risk, right, because there is high risk, and that is the mining stocks. Some of these stocks have hit 52-week highs this week, but most have not. In fact, there's hardly any stocks that are anywhere near their highs from 2011 when gold peaked at 1,900. A lot of gold stocks would have to double and triple just to get back to where they were 13 years ago. So the market is really cheap. Very few people are participating. People don't believe this rally, even though it's at new all-time record highs. In fact, gold is a contrarian play at record highs because there's so many naysayers in the market. There's so much fear out there. There's no greed at all. And so I think these stocks, the gold mining stocks, are really, really cheap. That's where I've got a lot of my money. In fact, I manage a gold fund, the Europe Pacific Gold Fund. People can buy that fund with no load at any of the discount brokers. It's EPIGX, I think, is the no-load symbol for the fund. But you can also go to Europac.com, get some information, talk to my representatives about how to buy the fund, or we even have separately managed accounts where we manage portfolios of these gold mining stocks. There's a lot of risk there, but relative to the upside, I think a lot of these stocks are not just going to go up 5 and 10x, but like 20x, 50x. This is going to be, I think, a huge historic bull market in gold and silver mining stocks.
Peter, when you start looking at fiat currency alternatives, gold and silver obviously are one alternative. Where does Peter Schiff come down on Bitcoin and other cryptocurrencies?
Well, I don't think any of the cryptos are really viable alternatives to gold. In fact, they're not even really currencies. They don't function as currencies. They're digital tokens that people own in hopes that they'll go up in price. But the only thing that will drive them higher in price is more people buying them because they believe that the price is going to go up. So they really operate under a Ponzi type, pyramid, chain letter, mentality. And so as long as people have confidence and believe that Bitcoin's price is going to go up, they'll buy it, and the people who own it will see the value of their tokens go up. But the problem with that is eventually you lose confidence and you run out of new buyers and the market collapses. And, people don't realize, despite all the hype, Bitcoin today is, in dollar terms, about the same price it was 3 years ago. So even with the introduction of all the ETFs, all the hype surrounding the ETFs, El Salvador coming in, Michael Saylor at MicroStrategy borrowing billions and billions of dollars to buy Bitcoin, these huge conferences and all this hysteria, the price has not gone anywhere. Meanwhile, in terms of gold, Bitcoin has lost about 30% of its value over the past 3 years priced in gold. And because gold's gone up and Bitcoin's not. Bitcoin stayed the same. So you got to ask yourself, if all this hype and all this, money couldn't drive the price higher, what will? And why didn't the price go up? With all the retail investors, all this money coming in, why didn't the price go up? And that's because there was a lot of money coming out. And who's been selling into all the hype? It's the whales. It's the people who bought their Bitcoin years ago at much lower prices. They are cashing out. And the people who are buying it now are going to end up being the bag holders of this scheme. So I wouldn't look at Bitcoin or any other token as an alternative. Look at Ethereum. Those ETFs just came out a couple of months ago, and they're already down 30 or 40% since they just came out. People are getting clobbered there, but they still have a long way to fall. So I wouldn't confuse it. They try to market Bitcoin as digital gold. It's not digital gold. It's got nothing in common with gold. It's no more digital gold than an image of a hamburger is digital food, right? It may look like a hamburger, but you can't eat it, right? You're going to die if you have a diet of digital food because you're going to starve. And so, don't be conned by, the image of Bitcoin and the way they market it. And if you happen to own Bitcoin and you're lucky enough to catch this segment, do yourself a favor and sell. In fact, Shift Gold, we make it easy. We work with a company called BitPay. You can actually go to Shift Gold and buy gold, and you can use your Bitcoin to get it. Because BitPay sells the Bitcoin kind of simultaneously and then gives Shift Gold dollars so that we can send you real money, gold, right? So get out of fool's gold and get yourself the real thing.
Well, I love the digital hamburger analogy. I'm going to use that, but I will give full credit to you. Peter, let me just get your take on one other thing here as the clock is telling us we've got just a few minutes left here. Warren Buffett dumped a lot of Apple shares this week, making headlines. He's dumped a lot of Bank of America shares. Does he know that we're in for a lower market? That's about all you can read into this, isn't it?
Well, yeah. He's obviously selling tech. He's selling banking. And, we're way underweight those segments in our funds. So, yeah, I think he's right. He's been around long enough. They don't call him the Oracle of Omaha for nothing. He's probably the most successful investor of our generation as far as long-term investing, value investing. And he knows that there's no value in this market. And that's why he's selling. Now, the question is, why is he holding so much cash? He ought to know better than that. He should be buying gold. He should be buying silver. If he wants to be liquid and out of the market, that's what he should own because he understands inflation as well as I do. He knows inflation's a tax. He's called the dollar squander bucks. I remember that article that he wrote. And at one time, not too long ago, Berkshire Hathaway had bought a bunch of silver. And not too long ago, they had bought stock in Barrick Gold. So, he knows about gold. He's not a big gold bug because he'd rather invest money than hold gold. But I know he knows that gold is better than cash, better than U.S. dollars. And so if he wants dry powder, the best place to keep your powder dry is in gold because if you keep it in currencies, it can be all wet because, we create enough inflation, stock prices will go up in terms of a fiat currency that's being inflated. But in terms of real money, prices can crash. And so Buffett is better off holding gold if he thinks the market's going to go down, because even if it doesn't go down in dollars, it will go way down in gold. and then he can use his appreciated gold to buy the bargains in the stock market.
Well, the clock says, Peter, we're going to have to leave it there. My guest today has been Mr. Peter Schiff. The website's Europac.com and Schiff Gold to check out Peter's work. I'd encourage you to do that. Peter, thank you for joining us today. Love to have you back down the road, and appreciate you taking time out of your day to join us.
Yeah, my pleasure anytime. Just stay in touch.
We will do so. We will return after these words. Welcome back to RLA Radio. I'm your host, Dennis Tubbergen, and thanks again to my special guest today, Mr. Peter Schiff, for joining us on today's show. If you've not yet requested the report that I'm making available this month, it is titled Tax-Free Retirement Income Strategies, and I'd be glad to send you a complimentary copy when you visit requestyourreport.com and let me know where to mail the report. And when you do visit requestyourreport.com and request the Tax-Free Retirement Income Strategies report, I'll also send you a copy of my best-selling revenue sourcing book that contains a retirement planning strategy for the new economy. Now, if you go back and take a look at Fed policy, take a look at interest rates, and compare these interest rate fluctuations, if you will, with the boom and bust cycles in the stock market, you see, at least in my view, a very strong correlation. Let me give you some examples. In April of 1989, the Fed funds rate was 9.84%. Just 4 years later, Alan Greenspan, who was at the helm at the Fed at that point, had reduced interest rates to 3.71%. That's a decline of more than 6%. The result was a tech stock bubble from the mid-1990s that topped in 2000 before the bust happened. Then once the bust occurred, the Fed's response was more of the same. By December of 2003, interest rates had been reduced to less than 1%, and the predictable outcome was another stock market bubble and a real estate bubble. Both the stock market and the real estate market then experienced a bust that bottomed in 2009. The Fed's response, predictably, was to reduce interest rates to effectively zero, but this time, the reduction in interest rates didn't work. And you have to ask yourself why that was. Here's my view. American citizens and businesses already had too much debt. It didn't matter what the interest rate on the new loan was, they just could not afford another payment. That being the case, the Fed then took unprecedented action. The central bank then embarked on a program of quantitative easing, which is, as you all know, currency creation. This radical policy was justified by stating it was temporary and would only continue until the U.S. economy grew its way out of the debt problem. Well, at that time, worldwide debt was $100 trillion. Today, worldwide debt is more than $300 trillion. So the next bust, in my view, figures to be a real doozy, as this level of unpayable debt will have to, at some future point, be purged from the financial system. Now, if you go back and compare debt levels presently to debt levels at the time of the Great Depression, private sector debt levels at the time of the Great Depression were about 140% of the economy. Today, private sector debt levels are 220% of the economy. Government debt levels in 1929, about 17% of the economy. Government debt levels today, about 130% of the economy. Total debt levels today, public and private, 350% versus about 157% in 1929. So debt levels are a lot higher. Why is it? Because the Fed has changed the money rules. Back in 1929, the dollar was partially backed by gold. That has not been the case since 1971, when then President Richard Nixon eliminated the link between the dollar and gold. So here's where we are today. Debt levels in the private sector are 50% higher than at the onset of the Great Depression when measured as a percentage of the economy. And since deflation is technically defined as a contraction of the currency supply, and because today's currency is debt, we are likely going to see a severe deflationary environment in the future once the inflation part of this cycle subsides. So what should you be doing? Well, let's look at 4 big picture concepts. Number 1, when the deflationary environment materializes, you're going to want to own some safe money assets. In my view, one of the best safe money assets to own for many people is an individual highly rated corporate bond held to maturity, not a bond fund. This was the number 1 performing asset class during the Depression, and in my opinion, it will be the best performing asset class when deflation fully kicks in. Big picture concept 2, prior to this deflationary environment emerging in earnest, you need to have inflation hedges in your portfolio to protect against near-term currency devaluation. An inflation hedge, simply defined, is an asset that can't be printed. Gold, silver, and some forms of real estate can be really great inflation hedges, again, for many investors. Big picture concept 3. I believe that buy and hold money management strategies should be avoided unless your time frame to use the assets is 20 years or more. Say many traditional mutual funds are governed by the published fund objective. If the published fund objective states that the fund manager will remain fully invested regardless of the overall conditions in the market, if you're in a stock fund and the stock market declines, that money manager has no choice but to stay invested. Finally, big picture concept 4, use active management in your portfolio that is trend following and that incorporates exit strategies. From my research and experience, I can tell you the best money managers in the world use trend following systems as well as exit strategies to preserve, at least that's the goal, invested capital. In the book Market Wizards, Jack Schwartz, the author, interviews the best and most successful investors and traders on the planet, and all of them use exit strategies. To that end, I'd like to invite you to get this month's special report titled Tax-Free Retirement Income Strategies. When you request that report at requestyourreport.com, I'll also send you a copy of my revenue sourcing book that contains a retirement planning strategy for the current economy and talks about how to manage assets in this inflationary environment that I believe will be followed by a deflationary time frame. So again, go to requestyourreport.com. I'll send you the report, the book. It's absolutely free. I'll also send you some bonus information. So again, the website, requestyourreport.com. The website again is requestyourreport.com. That's all the time I have for this week. I'll be back again next week. Thanks for tuning in.